Hi, my name is Jason Lightfoot. I'm a Senior Portfolio Manager at Futuregrowth Asset Management.
Hi, I'm Olga Constantatos. I'm Head of Credit at Futuregrowth Asset Management, and I'm here today with Jason for the fourth installment of our Let's Talk Infrastructure video series. So, Jason, you recently wrote an article that's available on our website about some proposed changes that the Department of Trade, Industry and Competition are looking at making to Regulation 28. And I think what that's looking to do is potentially increase some allocations for some targeted investments in industrial development type assets. And I wonder if you can just maybe talk us through what the proposed amendments are looking to do, and really at the heart of it, what is the problem that the Minister is trying to solve by these proposed amendments to the regulations?
There's a common misconception that the underinvestment by the capital markets, particularly so in respect of the pension funds, is as a result of a lack of an enabling legislation. Now, if we look at Regulation 28, its main premise is to set out limits in terms of how pension funds manage both asset and issuer class exposures within the context of their portfolios. This therefore ensures that they're able to manage both risk and diversification within those funds. Up to 1989, we had something in South Africa that was referred to as prescribed assets. This forced pension funds to invest up to 50% of their assets into debt issued by government as well as SOEs. This wasn't a great thing at all because it therefore resulted in undiversified, suboptimum portfolios that weren't achieving their true potential. And hopefully we don't see that ever again. More recent changes have adopted more of a carrot approach, and this was very much evident in the 45% allocation to infrastructure, which came through in January 2023. That ultimately did not have the intended outcome because it didn't magically create a whole pipeline of deal opportunities for pension funds to invest into because they weren't there to start off with. And right now, the Department of Trade, Industry and Competition want to introduce similar limits where they want to impose so-called industrial manufacturing caps. This, in our view, is a misguided approach because it doesn't address the true issues that are at hand in terms of addressing industrial development within South Africa. The core challenge really is one around a lack of bankable deal opportunities for pension funds to invest into. And therefore, by imposing additional targets on pension funds instead of addressing the true concerns that exist, in our view, is a misguided approach. So right now, the existing Regulation 28 limits or allowances do work. They allow for investments in these areas. But what we do need is a conducive environment for bankable deals.
Right, so Jason, it sounds then that the regulations are not the barrier. It sounds like the right environment is probably the barrier. And I think if we have to look back in history, in recent history actually, when there was the right environment that was created, we could probably look to the recent Renewable Energy Independent Power Producers Program, or the REAP program for short. And you and I both know that that was a very successful program that resulted in significant investment. And we've got some stats around that, which maybe we can share. So under that program, over 277 billion rand was invested in 117 projects over a period of 13 years. That resulted in over 6,200 megawatts of energy being generated into the grid. So that was to add additional generation capacity. And if we think about 6,200 megawatts of electricity, that's 13% of our current generation capability. And you can also think of it as 6 stages of load shedding. And so the right environment has been in place before, and the capital was very definitely there. As I said earlier, 277 billion rands worth of capital was deployed. And certainly that was one of the contributing factors, we think, to the lack of load shedding that we're all experiencing and frankly enjoying right now. And so maybe what we need to look at is what are some of the critical success factors that enabled REAP to invest this 277 billion of capital. And some of the things that I think that we've looked at is the standardized and robust legal framework, the appropriate risk sharing that took place, the regulatory certainty and the clarity, policy clarity that was needed, the risk transfer, I think I've mentioned that earlier. I think also importantly with the REAP program there was a risk-adjusted return, so pension funds like we speak for were able to earn an appropriate return for the risk that they were taking. And I think critically, the structures were set up in such a way that there was very little possibility for malfeasance or misspending, and the projects were scoped in a way that made them very much fit for purpose. And so, we've done it before. It's been done before. The right environment's been done before. And so, why don't we just do that again? I think is maybe the question we should be asking.
Yeah, thanks, Olga. I mean, RIP is a prime example. I mean, what we need right now is committed action to create a very much enabling environment, therefore ensuring that pension funds can invest in these opportunities. And in saying so, it's probably worthwhile highlighting, alternative approaches that we can look at without imposing arbitrary limits on pension funds themselves. And I think what we need, Jai, is ultimately a multi-pronged approach to tackle this problem. From an educational point of view, only 1,500 engineers graduate each year, of which only half of those go into function within an engineering field. This is a particular concern and constraint within the municipalities, and it's ultimately evident in the dire state of the infrastructure across the country. If we want to grow our gross fixed capital formation as a percentage of GDP, we need to increase our numbers of engineers within the country.
Okay, so picking up on your multi-pronged approach, we need more engineers. That's very evident. One of the interventions that government has spoken about is mobilizing private capital to invest alongside government in public-private partnerships and things like that. And I guess one of the other interventions in terms of this multi-pronged strategy that we would need is capacitation of the state, not just in engineering skills, but also potentially financial skills, and in order to execute these projects. But I think critically what's also needed is mechanisms to ensure that there's no malfeasance and no corruption, and making sure that the money that is raised for these projects and for infrastructure is actually going to where it's intended. I think what's of particular concern is that recent news has told us that only 34 municipalities out of a total of 257 actually achieved clean audit outcomes. And so that's a particular worry when you think about the deployment of money and how that's going to happen, whether these projects are going to be cost effective and whether that money is going to be directed into the projects and building the infrastructure that is actually needed. And so we need this climate that encourages bankable projects to come to market regularly. And we need to ensure that the deal structures and the legals allow for this appropriate risk sharing. Because I think what's important to remember is the role of pension funds. Our role is as capital provider. That's it, right? We're not there to do anything more than that. And so we can only, as fiduciaries for our clients' money, we can only deploy that capital into projects and investments that are appropriately risk mitigated and also are earning an appropriated rate of return. If we can do that, if we can play our role, if government can play their role, then the capital should flow, right? I mean, is it really as simple as that, Jason?
Yeah, I mean, 100% agreed. I mean, it's important for us to oppose counterproductive measures that will do nothing to cultivate a pipeline of bankable opportunities that pension funds can ultimately invest into. And this is a view that's shared widely amongst the investment community. We need an environment that ultimately encourages the development of bankable opportunities that pension funds can ultimately tap into. And this will ultimately open up a pool of opportunities to fund various initiatives. To put some numbers to it, the current size of the pension fund industry in South Africa is north of 5 trillion rand, with a small portion of that currently invested into these sorts of opportunities. So there's definitely an opportunity set to tap into, but premised on the basis that these deals need to be bankable. It's therefore important to oppose counterproductive measures as suggested by the department. So as we reflect on today's discussion, it's clear that our collective efforts are required and essential for unlocking the true potential of our country. Ourselves as asset managers and the pension funds, therefore by ensuring that we have capital available for opportunities, and the public sector for ensuring that they create an enabling environment. So this focus on amending Regulation 28, in our view, is a misguided approach. It's not addressing the true issues at hand. We need more focus, therefore ensuring that we create this enabling environment to address the true concerns.
Thanks, Jason, and thanks everybody for joining us. And please do join us next time as we pick up on this conversation and talk about some more of the reforms that are needed and the enabling environment that Jason and I have spoken about today, and what else is needed to get economic growth and investments that we so desperately need. Thank you very much.